Welcome to another video in Market Talk YouTube channel. Today, for a difference, we are going to review one of my favorite books, The Profit Magic of Stock Transaction Timing, written by Hurst. Some of you would have known about Hurst time cycles. So this is the same person. He is an engineer by profession. So this is one of the famous books in 1970s. It is almost 50 years old, but still this concept is working a lot. This is one of my favorite book. I thought of bringing you the snippets of this book for your understanding. Hope you will like this video. I am not making it too big, just 10 to 15 minutes video it will be. Let me start. Hurst was an engineer actually, basically with 25 years of experience. He is interested in a lot of research. He has put his 20,000 hours of research in bringing this book actually. He is asking question whether $10,000 can be converted into $1 million in 15 months. Yes, it is possible. He has given some practical approach also. All these you need is effort, knowledge and psychological barriers, how to break it. These are the parameters you need to adopt. The power of compounding with transaction timing capability, which is better than the traditional investment method. We are going to see some illustration how this is possible, what is transaction timing capability, all these things we are going to learn. You will know the following from going through this book. Actually, there are 11 chapters in this book totally. So in this video I am going to explain about the contents of chapter 1 only. Concept of profit maximization, how to do profit maximization, and what is stock price motion model. In the entire book these are things which is explained actually. Prediction implications, and what is the chart forms, why stock price fluctuates, how to make benefit from these fluctuations, and how to maximize your profit, when to buy, when to sell, when to wait, and when to hold, when to short sell, cover short, protect profit. All these things are explained in this book with the logics. Scientifically it is being explained. How to use moving averages in transaction timing, and how to select the stocks, analyze and make profits using concept of profit maximization. And also he is explaining about numerical spectral analysis. So we are going to see all these things over a period of time. In this first chapter we are going to see how to maximize your profits. What is the concept behind this? Where the magic is lying inside this maximize your profits. The main theme is whether you do trading or investing, which is better. So many of you might have been told that investing is better, but his concept is entirely different. He explained how trading is completely better than investing. Most money can be made in the least time with this technique. And the trading interval that affects the profits, how the trading interval affecting the profits is also one of the concept, and how adding the power of magic of compounding into this model also is going to maximize your profits. And always his concept is to maintain 100% of the investment into the model. There are 4 steps to riches. So all this is going to be covered in the first chapter. So why is stock price fluctuate? So this is the reason behind this, starting this his research actually. So buying low, selling high is the best way to maximize your profits. But is it possible? Whether buying low, selling high, everything is theoretically possible, but practically may not be possible. That's what everybody has been understanding. When is the low, when is the high, we don't know. Many will tell you that if somebody can tell when is the low, when is the high, whether it should be God or it should be a liar. The important time is timing. So timing is very important in taking a trade decisions of buying low and selling high. The transaction is called transaction timing. So when to buy, when to sell is what is called transaction timing. So hope you understand the concept of transaction timing. When you buy and invest, assuming for you want to hold for long term or 10 years, 20 years like that, you buy and hold, then it is a long term investing. But trading is you buy, and when the swing high reaches you sell, and you do short sell, then come down, you square off your position and make a buy. Is what swing trading, and also concept of transaction timing. Let's deal with short term yield and the profit compounding also. So whether to trade or investment is a big question mark. We need some justification, which is the best. In case of investment, we get dividend yields. In some cases you get a good dividend yield, but the stock may not rise at all. But in case of good stock, you get a very low dividend yield of 1%, 2% only. But in case the stock crashes, then you entire capital, whatever capital loss we see may not be taking care of, the dividend loss may not be able to take care of our capital loss. Zero risk is there in case of blue chip companies. The top 10 companies which is having high weightage in the index stocks is no risk, but there also you can make money. I'm going to show example of how ICICI Bank is a blue chip stock, how you can do trading and get better results instead of long term investment also. So we're going to see a practical illustration of the recent data to explain this concept. 9 to 100% perfect ability can be achieved using transaction timing technique, stock pricing model. This is what is explained in this entire book actually. And how mutual funds are making money? Do they buy and hold some stock like Infosys or TCS or Reliance and make money? No, actually they keep shuffling the stocks. They buy some stock, they sell at some very good price and then shuffle the stock into other stocks. This is how they do making money. That's the reason we are investing in mutual funds where they do trading. Ultimately, you make money by trading only, indirectly through mutual funds. So money is to be made in the least time. That's the most objective thing. It's not that you doubled your money over a period of 20 years. It doesn't matter. It does not have relevance. If you make money in 20 years time, it is just 5% per annum. So it is not almost like your fixed deposit return. So is it not worth it? Example is ideal example was Reliance Industries. Reliance Industries was not moving at all in a range for almost 10 years. After that, it started moving. So entering the stock Reliance when the breakout came was the ideal way. In this example, if the stock was not moving for 19 years, you keep the 19 years in the money in the FD and put the stock money in the stock market, the particular stock for 1 year for 100% return. So you maximize your profit. So this is the way is called transaction timing, making money in the least time. So for this you have to understand how you can get maximum return per year and how each trade can give you maximum return. This is the way the two things you have to see. And you have to use the maximum use of time. So which stock can give you best return in the least possible time in the stock selection process. Everything is fine as theory, but how to go about? This is a question everybody might be asking. But for this you have to complete the entire book. So now we are going to complete only the first chapter. Remaining chapters we are going to see. Next continue the remaining part of the first chapter. So taking example, he has given the author has given the example of one stock which is not I am covering here, which is irrelevant or obsolete, but I am taking the stock of ICICI Bank for our practical purpose. So there is a swing high from March low, we reach almost from 284 levels to 360 levels in the span of almost 3 months time. Now I take the example what is illustrated. I have just transformed this into our practical example which you all can understand. So on 24th March the low was 268, you buy some 100 shares with investment 27,000 rupees and then you sell on 30th April the swing high, then you sell at 393, you make a profit 12,500. In 38 days you make 47% return. Opening capital this much and closing capital 13,300. Similarly, when you see the top there, you don't wait for a low again, you do short sell. You sell 393, 13,300. I am taking margin of 13,300 only. I checked in the ICC also, website also, and the F&O margin for 1,350 shares. The margin record is 1.6 lakhs. For 100 shares, it will be almost 11,000 rupees only. But still, I am taking 39,000 rupees as margin, and I am selling here and covering at 285 rupees. Then you make a profit 10,800 in 23 days, which 27% return on the investment. So this way you do sell, buy, and when you sell here, you make the quantity 100 same, and then buy here 100 quantity, whatever the same quantity you do it. Every swing you buy and sell. Here you are compounding your money from 26,800 to 69,400 in almost 3 months time. So this gives a return of 115% for 93 days and 624% for per annum, 625% per annum. But if you invested this money as buying here until now here, if you kept it there, you would have got 42%. Instead we are getting 159%. It's almost 4 times of the return what you got it by trading taking 5 trades in the stock in the period of 5 months. So definitely you know what is the importance of transaction timing. Everybody is again keep wondering what is the result of how to do the identify low, high, who knows this is a matter of concern. So over a period of time we are going to learn all these things. Now this is a chart he has explained what is this called, this waves, how to identify this wave. This is what is going to explain in the coming times. So this is called price motion model, and this is worth a study where you can find the low and high and make a good return from any instrument. And you can also remove the fear that when the high will come, when the low will come. This is everybody's question. So all these questions answer will be getting in this book actually. So this is the thing what we saw here in the earlier slides. Now maintaining 100% investment all the time, applying this principle and the power of compounding. What happens when you make a profit after the first two trades? Your capital is coming to 50,000 rupees from 26,800. Now investing 50,100 rupees, the number of shares that you can get is 176. Now again, once you finish one round of buying and selling, then your capital goes 74,000 rupees. Okay, I have taken less actually, 74,000. Then if you take that, then the amount will be more actually, and you can make 218%, which is more than almost 250% will be actually 215% in 93 days. Let me just see that example also how it is practically coming. Okay, I'm just changing it live, and the capital is 74,000 rupees. Now the return is 225% is the return actually. Okay, and overall per annum return is 1882% return. So this is unimaginable return which you are going to get it using this stock pricing model and transaction timing with maintaining 100% of investment and power of compounding. All this together will give you the power of stock pricing transaction. So what we learned in the small slides is how to do, what to do, trade or invest. This is understood, answer you know, and we have to always maximize your percentage per yield year, and what is the maximization of percentage of time invested. In the shortest time you have to do the maximum investment, and minimization of the trading interval, and then optimization of the transaction timing, and then maintain 100% investment. So this is the contents of first chapter. Hope you understand. The main concept is transaction timing, buying the low, selling the high. This is the concept. So how to effect it, how to implement this, we are going to see in the remaining chapters. I am planning to release one by one videos as and when I am completing the presentations. Okay, hope you enjoyed the video. Please subscribe to the channel, like the channel. I will be bringing you more contents which is going to empower your trading brain. Thank you.